The Federal Open Market Committee reaffirmed the current 0 to 0.25% target range for the federal funds rate. Since the committee met in July, the pace of job gains has been solid. The unemployment rate has declined, and overall labor market conditions have continued to improve. Inflation, however, has continued to run below our longer-run objective, partly reflecting declines in energy and import prices. Recent global economic and financial developments are likely to put further downward pressure on inflation in the near term. These developments may also restrain U.S. activity somewhat, but have not led at this point to a significant change in the committee's outlook for the U.S. economy. The committee continues to anticipate that the first increase in the federal funds rate will be appropriate when it has seen some further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. The outlook abroad appears to have become more uncertain of late, and heightened concerns about growth in China and other emerging market economies have led to notable volatility in financial markets. Developments since our July meeting, including the drop in equity prices, the further appreciation of the dollar, and a widening in risk spreads, have tightened overall financial conditions to some extent. These developments may restrain U.S. economic activity somewhat and are likely to put further downward pressure on inflation in the near term. The recovery from the Great Recession has advanced sufficiently far, and domestic spending appears sufficiently robust that an argument can be made for a rise in interest rates at this time. We discussed this possibility at our meeting. However, in light of the heightened uncertainties abroad and a slightly softer expected path for inflation, the committee judged it appropriate to wait for more evidence, including some further improvement in the labor market, to bolster its confidence that inflation will rise to 2% in the medium term.
I don't know if I should call it completely surprising, because about half of the people thought the Fed was going to raise rates and half of the people didn't. But nobody was focused on the Fed saying international factors were keeping it from raising rates. And so this is what's raised some eyebrows today. Well, I was saying that the Fed would not be raising rates. I think that the Fed has been undershooting its inflation target. And I've been saying for a long time the international factors are a big problem, not just dropping oil prices, but weakness abroad. Mario Draghi, for example, head of the ECB, has said that Europe could see some negative inflation rates over the next 2 months. So it's pretty clear that there are a lot of downward forces on inflation around the world. And the Fed has now formally acknowledged that and kept policy on hold.